Hi, this is Osama Rizvi and welcome to another episode of Monday Macro View. Today I'm going to talk about three things: US default, the gold rush and the oil markets, because all of these three markets are experiencing some really interesting movements and developments in terms of its price, in terms of its future trajectory. Starting from US debt ceiling, this chart very neatly explains what this whole debate is about. So we have October 3rd, 2005, then we have December 2021, when the last debt ceiling was raised, and then we have today. Right now, the US debt ceiling stands at $38.4 trillion, and the expectation or the hope is that the debt ceiling would be raised in the coming days or weeks. Why is this important? Because, of course, if the US defaults on its debt, in theory, it can result in an economic chaos for not only for the US, but for the rest of the world as well. There are lots of moving pieces to this. But one thing that I wanted to really discuss is the 14th Amendment so I'm not a legal expert, but I just read this and I thought it would be really good for the listeners to be aware of this, in case not anyone is, that the 14th Amendment, which deals with mainly equal protections granted to citizens under law. So the fourth section of this amendment reads that the validity of public debt of the United States, authorized by law, including debts incurred for payments of pensions and bounties for services in suppressing insurrection or rebellion, shall not be questioned. What does it mean in simple words? It means that Biden can invoke this fourth section of the 14th Amendment and claim that he has the power to authorize the Treasury to pay the US debt, even if the Congress does not agree to raise the ceiling. So this is just only one aspect, and I'm certain there would be hundreds of other aspects of this as well. But what I'm trying to say is that this is a very nuanced issue. Some say that it can be a protracted debt default in case the Congress does not decide when to raise it, or if in case it faces any delays in it, or it can be a short one. In any case, if there is a default, that can lead to some serious economic effects, which brings us to the second slide. And you can see here, this is from the White House. It was released in the beginning of the month. And you can see how the protracted default scenario that I just talked about, it results about 8 to 9% fall of 8 to 9 million jobs losses. Similarly, in case this would precipitate in the quarter 4 of 2023 and the quarter 1 of 2024, however, it'll get better. But just imagine that with the ongoing happenings, with the ongoing quantitative tightening, which, by the way, according to Fitch ratings recently, can result in up to sucking up $2 trillion of liquidity from the global markets, that can be extremely, combined with all these developments, this development can lead to some serious contraction in the global economy and also a very prolonged period of slow economic growth. So that was really interesting. Moving forward, something related to this, as this debate about debt ceiling is quite hot these days, the CDS ratio, which is the credit default swap, which is in a sense the insurance against a default, a possible default. The US, the credit risk of the US is now higher than Mexico, Greece, and Brazil. That is something which you don't see usually, and this is very important because it shows the overall market sentiment of the speculators, of the observers, of the traders specifically, and naturally it can result into, although nothing physical has happened and there has been extraordinary measures, quote unquote, according to Janet Yellen, which have resulted into paying out different liabilities because the US debt ceiling was breached back in January 2023. So, but what I'm trying to get at is that even the current debate, even the current ongoing, dilly-dallying in reaching a decision, that can cause a significant damage to the equity markets. It is already playing its role, a significant role, I would say, in the oil markets, where oil prices are constantly under pressure. And sometimes the headlines say that the bullish factors are overtaking, sometimes the bearish factors are overtaking. It's funny actually to an extent, but fundamentally, if you take this thing out, the oil markets remain bearish, and we'll talk about that. But something that is relevant to it and related to it is the gold rush, because recently, so the gold had different sorts of demand. Right now, it's one of the reasons or the drivers of a rising gold prices, which have just recently fallen a little bit, is the risk aversion. Global economy is under pressure. There is a lot of recessionary talks. And other than that, it's very important that central banks across the world, they want to diversify their reserves now. Because of the Western sanctions, because of what's happening, because of the bigger picture changes that we also spoke about, in the previous shows. So the World Gold Council publishes this data, and according to that data, the central bank purchases hit a record high in the first quarter of this year. So that's something that is really important and also speaks to the bigger picture changes in the international financial system. We'll speak about them some time in the future. Now, oil markets. When I talk about oil, China comes into play, of course, because China is one of the largest, second largest economy in the world, one of the largest drivers of global oil demand. And according to many organizations, it is going to be contributing about anywhere 50% to 55% of demand of oil demand in the coming months, or for the rest of the year. So the countries, there was some recent economic data that came out, and it was disappointing when you contextualize it. For instance, the retail sales jumped to 18%, but this was when you compare it to the previous lows when there was a lockdown. And now the retail sales, the expectation for retail sales was 21%. Similarly, industrial activity rose only 5.6%, whereas the expectation was about 11%. The youth jobless unemployment rate jumped to a record high of 20%. The coal production, aluminum output, and crude steel output also fell in April in China. So that's something, the imports have been shrinking. We have been talking a lot about China's falling oil appetite. Recently, the Chinese refiners dipped into their inventories that they have built in the previous few months. So what we're looking at is that it's not a very dire scenario of an economic slowdown, but certainly what the expectations from China post-COVID-19 or the reopening of China, as it was said, it has disappointed certainly to a certain extent. And the case still remains out there that whether China will be able to pull off such an economic demand recovery, and it will cause a demand surge in rest of the commodities, at least for the rest of the year. Moving forward, Russian oil exports hit post-invasion high. This is very interesting. We've spoken a lot about this, but this continues to be a very important theme, because Russia and China and India, they now Asia is in focus, and these three countries, specifically Russia in terms of oil supply, it continues to make headlines. However, even though the exports have hit post-invasion high, this was 27% lower than the same month in 2022. Also, the oil and gas tax receipts have fallen about 64% year-on-year basis. There has been a bit of a dent to this to Russian oil sector, but still, it is going strong. And that really puts into debate the whole enterprise of sanctions. We'll speak about it some other day, of course. Finally, the market sentiment tracker, the bearish news continues to pile up. G7 countries have warned of consequences of economic coercion, specifically in terms of China and what's happening with the US. China oil imports were lower, fixed investment in China fell. A recession is to be expected in the second half of 2023. Falling economic leading so there are different indices, and all of the economic indices, such as leading economic index by Chicago Board and others, they're falling. The UN actually has called for a low and prolonged era of low economic growth. So that's all from today. I think the case is still out there, but I think the global economic indicators are clearly bearish, and it will continue to pile up. I hope it gets better soon, but I think it'll get ugly before it gets better. See you all next week. Thank you so much.